just to cover off on Origin first, I haven't spoken about it in a little while. We did downgrade it to a hold back in December. It was trading at about 670, so now it's trading at 770. So I'm sure a lot of people in the network are trying to work out what to do with it. Really, the reason why I haven't downgraded it to a reduce is the fact that it's really been driven by some pretty strong tailwinds in terms of earnings and catalysts that really will take some time for me to reckon to reverse. And really, most of those are aligned to its retail and generation business. So you would have seen over the last few years that the big portfolio of generation assets that Origin holds have actually been a drag on earnings. That they're really hurting the company's economics versus the company, other retailers who are just sourcing electricity freely from the market. But that's flipped into being a strong advantage in the current conditions, given the fact that electricity prices are rising so sharply, as are procurement costs to source power. So for Origin now, where half of their book is covered by their own generation assets, they really are getting some really strong margins coming through. And in addition to the very economically sourced renewable PPAs they're actually signing up for as well, which help them on their REC needs. So really putting all of that together, the energy markets business was something a year ago was already generating $1.5 billion a year in EBITDA to Origin, and was really supporting its oil and gas business. That's continued to grow and continue to strengthen, and could keep running for a little while to go. Then you look at what's happening in the oil and gas side of the business, and especially APLNG. Both trains have been ramping up very smoothly, running ahead of nameplate capacity, other than some maintenance shutdowns they've had so far. So while the oil price hasn't done a great deal, and really, like GLNG, we haven't seen Origin pump and its partners pump more capex into upstream to really ramp up gas aggressively. They're actually much better supplied with gas versus Santos and GLNG. So things are running much more smoothly there. And it just leaves the company with strong cash flow from its energy markets business, and then leverage to oil if the oil price does rise through APLNG's cash flow. So one thing to keep in mind is that for me, I'm expecting it to be about 6 to 12 months before a dividend comes back on the scene, but could be as much as 24 months depending what the oil price does. So there's no dividend still. And I'd have to say, beyond some of those strong tailwinds, it is trading 20% above our valuation. So it is overpriced. I just think that some of those tailwinds could keep pushing it for some time to come. So all in all, that comes down to, I'd be happy for people to take profits, but I think it's worth keeping some in the portfolio, a quarter or half your position. But other than that, just happy to take in that profit. Moving on to Fortescue, you would have seen, I'm sure it would have shocked some people that we upgraded it to a buy this week. Really not suited for everyone. I'm sure that's not a surprise to anyone, but the fact that the company's been pounded down 30% in share price, iron ore prices have come back and corrected the way that much of the market had been waiting for, and really for us, what drove our negative view earlier in the year that low grade producers would receive a double whammy from surging met coal prices from Cyclone Debbie, falling steel prices in China, which hurts the profitability of their customers, would combine to see those mills really prioritise higher grade iron ore to try and minimise the amount of met coal they needed in the mix. So that saw essentially the discount Fortescue receives for its iron ore blow out to 25%, which was astronomical and beyond what we were thinking. But now with the met coal price having really come back quite hard, back to about $150 per tonne on a spot basis, those factors are starting to reverse. So steel prices are still quite weak. Iron ore price is still quite weak, but we're seeing both of those start to hopefully plateau a little bit and consolidate around here. And with met coal normalising, hopefully we'll see that discount shrink just as the iron ore price finds a bit of a floor. So given Fortescue's heavy underperformance in share price over the last month, as you'd expect on a falling iron ore price, hopefully that creates a bit more cushion. We see that discount start to shrink and go back towards 13 to 17% sort of range, which is a positive versus its peers, and you get a good trade out of it. So we're there for a good time, not a long time. It's certainly far removed from the likes of South 32 or any of the other peers I cover in terms of quality, just given the magnitude of sensitivity it has to a single product it produces. But I do think there's a 25% potential return for traders with the risk tolerance to be there. So happy to add those ones at the moment.